Welcome to TheoTrade. This is Don Kaufman doing the weekend update here. It is April 23rd, 2016. We are kicking it off here looking at three major indices. That's right. To kind of start it off here in the weekend update, we're going to look at the convergence of three major index products. What I have right now is plotted for you. The NDX on top, which of course is representative of the Nasdaq. So let's just label them over here so we're all completely clear. Here happens to be the Nasdaq. Right in the middle over here is none other than the SPX. Okay, so here's the NDX, the SPX. Last but not least, down below over here, we happen to have the Russell. Now, the reason I'm actually bringing up this comparison chart is something I've been talking about really since the inception of TheoTrade, is getting comfortable looking at ultimately comparison type charts. One of the reasons we're looking at it here is, again, there has been a monstrous divergence over many years of the Nasdaq versus the S&P versus the Russell. In this particular case, what you're looking at right now is a comparison chart for just the last year. And in just the past few days, look what the Nasdaq is doing versus the S&Ps and ultimately the Russell. So there's this much broader convergence of these three products underway, and has been underway for quite some time. So let me go ahead and blank this and actually switch the time frame. So that's a 1 year. We're actually going to go to a 3-year daily. And what I want you to see in the 3-year daily is, again, on top, we have the Nasdaq, and it's really the outperformance of the Nasdaq versus the S&P and, of course, the Russell here. In any period of extreme volatility, which we did see back December, January, what you're ultimately getting is the Nasdaq over-accentuating the down move and coming closer to the S&P and, of course, the Russell here. So in periods of extreme volatility, we see what we call convergence. That is, all three major index products, like back here, converge upon one another. Well, again, over the last couple of years, there's been this monumental divergence in these products. Right now, it appears, once again, in just the last few trading days, the convergence, once again, is underway. So in periods of a rally, like we've seen the last couple of weeks over here, again, the indices have tendency to diverge apart. The Russell, in this particular case, that was actually outperforming in this rally, coming closer to both the S&Ps and the Nasdaq. But the Nasdaq has completely diverged course on some of the earnings announcements that came out this week. Blame it on anything that you want. The bottom line is right here could be indicative of some volatility ahead of us. And that's exactly what we're looking at right now. It has been the Nasdaq that's been on the leading edge of volatility in all of the events in kind of recent history over here. So I'm not one heavily into technical analysis, nor am I looking at any particular studies over here. But in a comparison chart with percentage terms over here, we can get, again, much more statistical view of what's going on in the market. Now, this is, again, like a 3-year weekly, but let's zoom this all the way down, for instance, to the last 3 months. And what you're actually getting in the last 3 months now is Nasdaq underperformance. So the Nasdaq, again, turned south in the last couple of days. But let's clean up the chart, give you a little bit of review of what happened this last week and what we've actually got coming this next week. Remember, again, the market might be displaying its first signs of volatility coming back over here, and that being the Nasdaq breaking to the downside. So I kick it off here with the SPX, which just had, again, this is a 9-month daily. We'll even bring up a full 1 year over here. Where have we been over the last year? Absolutely nowhere, but we had to get everywhere to get nowhere. Sometimes I like to bring into some perspective the number one, the rally that we've seen the last couple of weeks, which, you know, portions of it I've been short, and now I am very well allocated to the short side. So I make no two ways about it. I am short. Okay, I'm short some S&P futures. I'm short some Nasdaq futures. I'm actually short some in the SPX. It's a party. I'm short. If you're kind of curious, I'm short now about 6,000 spider deltas. That's equivalent to the spider. So I'm short the equivalent of about 6,000 shares of the spiders. And I don't know about you, but I like it because it's all about collecting premium and maintaining my directional bias. One of the sayings we have here at TheoTrade, duration over direction. It ultimately means I'll be able to sustain that position. I'm comfortable with being short 6,000 deltas, and I'm going to collect plenty of theta, which is time decay, in essence, to be able to do that. But again, putting some perspective in the market, we've gone absolutely nowhere. Yet traders are constantly screaming about, directional bias and so forth. Again, look at the broader marketplace. We've gone absolutely nowhere over the last year. Still a premium seller's market, even in this low volatility. Now, the reason I wanted to bring this up, it's not the SPX that is really on my mind over here this week. Once again, it happens to be none other than the Nasdaq. So we're going to go look at the Qs. Okay, why the Qs? Because they broke. All right, and they ultimately broke to the downside following Google. All right, which again did not fare very well. Microsoft right there with it. Microsoft down over 7%, but well off the lows of yesterday's trading session. Google, the exact same thing here, well off the lows of the trading session. Look at that. Like Amazon came back, a good $10. Nevertheless, I want to start with Qs over here, which gapped and broke lower. Again, to be watched. It's a big time divergence. But I'm not here to look at a chart. I'm not here to tell you what you think you might see in terms of a product going up or a product going down. Clearly, I am short, but that is a much longer term decision on my behalf. Now, what I do want to display to you here is a little bit about the implied volatilities, because this is something, again, anytime you're watching anything here at TheoTrade, if it's going to be worth your time, I got to show you something that other traders, they're not looking at, and they're not reading kind of between the lines over here. Number one thing I want to kick off with, if you look at the Qs, okay, and the Qs in the Nasdaq is known for having slightly higher volatility. So let's go ahead and just highlight that in the very short duration here, okay, volatility is absolutely elevated here. It's almost up to 18%. Granted, what do we have coming out this week? All right, so this is not about backward looking. Who cares what happened with Google? The fact that the market itself remained unscathed in the fact that Google was down 5%, that ultimately Microsoft was down 7%, okay? Yes, that has caught my attention that the market remained unscathed, that most products were up. But what's really catching my attention is when you look, okay, 6 days out, or look 13 days out, the Nasdaq actually has an inverted volatility skew. You don't see this, okay, unless markets are in the midst of like much more extreme vol. So the vol skew flipped over. Now, again, what's kind of entertaining about this is if you looked at another major ETF, the spiders, or you could look at the SPX if that's more comfortable for you. If you look at the spiders, they're not, all right, anywhere near the volatility of the Qs. So why do I point this out? Again, Captain Obvious, Apple's going to have earnings. It's coming out on Tuesday, all right? Facebook's later in the week out there. There's a bunch of underlyings that are going to have earnings. But it's Apple, okay? And what the Qs are ultimately saying and what the market is screaming right now, Apple is going to make or break us. That's it. Apple is going to make or break us. There's no other reasoning for, okay, volatility to actually be flipped over. Now, people have heard terms called like contango and backwardation over there. Nevertheless, short duration volatility in the Nasdaq has now exceeded longer duration volatility, which means risk is imminent. But that's, again, very unusual to see Nasdaq volatility drastically higher than it is in the spider volatility. Lately, those have been relatively the same. One last thing to look at in the Qs. Again, I don't think a lot of people are actually seeing this, is the market is displaying risk to you. The IV percentile is still incredibly low in there, which means we're still towards the much lower end of spectrum of volatility. But again, Apple's announcement couldn't be more critical for the marketplace. Now, to back up for just a second. So we looked at the Qs, which are displaying risk now. Risk is imminent. The next 6 days are actually seeing considerably more risk. okay, than, for instance, 13 days out. And again, an 18 vol in here, it's not half bad. All right, this market's kind of getting it done over there. Again, you have the Qs, right, in the same category is in terms of the IWM. When was the last time you actually saw Nasdaq volatility exceeding Russell volatility? You don't see that too often, do ya? Okay. Now, what's shocking about all of this? Let's go to the SPX for just a moment. Okay. Again, we're only looking forward here. Forget about like last week. It's neither here nor there. Now, what's shocking about all of this? Look at the 4-day options here, okay, inside of the SPX against the 6-day options. The 4-day options are showing 11% vol. The 6-day options are showing about a 12% vol. Did you look at a calendar as well? Maybe you have, maybe you have not. There's actually an FOMC announcement coming this week. The markets are pricing in like no risk to it. Do you realize the market for the entire week is pricing in only about a $27 expected move? I don't know about you, but I'm actually buying it. What does that mean? It means I'm coming in Monday morning. No matter what markets are doing Monday morning, I'm actually going to be buying up volatility Monday morning. It's not often, again, that I go out on a limb and say something like this, but volatility looks way low for the amount of risk that's coming this week. Okay, the Nasdaq is clearly disseminating to traders. Risk is here. What? The SPX? Nothing. We're getting nothing out of it. And there's an FOMC announcement. I actually looked at the calendar. I even pulled it up, right, just to make sure. I'm like, am I right? Is there really an FOMC announcement coming this week? The reason I kept doing that is because I couldn't believe the fact that the implied volatility was that low in the SPX. Do not let it put it to sleep. Okay, and that's really what I think a lot of traders have fallen into. That it's a lull in the market. We're going to do nothing more than rally over here. Nevertheless, okay, there's some risk on the table out there. Last but definitely not least, let's go look over at the XLF, which is the financials. You'd think they'd actually feel the brunt of it. Check out the financials. They're almost up to a 20% implied volatility. So now we're looking, okay, the financials, number one. The Nasdaq, number two over here. You realize that those are the largest sectors inside of the S&P. Both of them, okay, have close to what we call like a 20 VIX in the next 6 days, right? So both of them are displaying heavy risk inside of very short duration. The SPX isn't doing anything. It's actually just, call me when there's volatility over here. I've said this for many, many years. The index product, the SPX, tends to trade what I call volatility stupid. It doesn't see volatility till it's right pouncing on top of it. Now, again, for earnings, yes, we have Apple this week. Yes, we have Facebook. Later in the week, it's actually going to be Chevron, ExxonMobil over there. All of them are market movers. Okay, last but not least, if you're looking at Google, if you've looked at Facebook, Microsoft, okay, and then we can go on and on. Individual stocks that are getting hammered from earnings announcements, the market itself remains rather unscathed over here. Yesterday, in a pretty shocking event to me, actually I have 8 of 10 sectors in the S&P up on what? I have absolutely no idea over here. Again, how the markets remained unscathed is still kind of beyond me. It doesn't matter. At this point, you got to read the fact there's no volume out there. S&P futures yesterday, with all of this going on, only did 1.48 million contracts. Anemic volume. There's no commitment in the trade out there. All right. Again, Apple's earnings are going to be pivotal. FOMC meeting, there's a lot that can happen. I'm going out there and actually buying some more volatility up. That is, an expansion of volatility could be underway. Nevertheless, how am I going to do it? All right. Well, I'm going to go into a product like the spiders. I'm going to be buying short-term straddles, and I'm going to finance them, okay, ultimately through means of selling also short-duration options. Something I'm going to be showing throughout the course of the week here in the TheoTrade chat room. Join us all week long at TheoTrade chat room. I'm actually going to be doing the trades on Monday. Again, we're going to be buying short-term straddles and actually financing those straddles. by also selling short duration options. Net though, I will be getting long volatility. Ladies and gentlemen, you haven't seen this one before at TheoTrade. Don getting long volatility, okay, by buying options. Thanks a lot, everybody, for joining us here for the weekend update at TheoTrade. We'll be back all this week in the chat room, coaching sessions, classes, and more. Thanks, everybody. Have a great weekend. Bye-bye.